Good afternoon. My name is Campbell McCrary. I'm a Vice President, Capital Markets at Amvest Capital in New York. Welcome to the Amvest Capital Inc. live webinar with Rubicon Minerals. Rubicon trades on the TSX Venture as RMX and on the OTCQX as RBYCF. We hope you'll enjoy today's program. It will also be available in replay mode. Feel free to chat in your questions in the question pane of the GoToWebinar control panel, or simply email them in. We'll try and ask the questions in real time or after the webinar. Amvest Capital is a New York-based specialist investment management and corporate finance firm focused solely on the natural resource sector. This call is hosted by Amvest Capital Inc. All opinions expressed do not reflect the opinions of Amvest Capital Inc. or any of its affiliates. This call is for informational purposes only and does not constitute an offer to sell or the solicitation of an offer to sell or buy any security. It should not be relied upon as a basis for investment decisions. Amvest Capital Inc., its affiliates and clients may maintain positions in the digital assets or securities discussed on this call. Presenting today, we have George Ogilvie. George, I'm going to make you presenter. Please pull up your screen. George is an engineer by background and has more than 30 years of management, operating, and technical experience in the mining industry. Previously, George was the CEO of Kirkland Lake Gold, Inc., where he and his team improved operations at the Macassa mine and elevated the company's profile with the acquisition of St. Andrew Goldfields. He barely needs an introduction just for that accomplishment alone. Prior to this, he was the CEO of Rambler Metals Mining PLC, where he and his team guided the evolution of the company from grassroots exploration to a profitable junior producer. He also has had background includes positions at Anglo Gold, Hudbay Minerals, Dynatech as well. Following the presentation, members of Amvest Capital will ask questions of management. We also look forward to any attendee questions that will be sent in. If you can figure out the webinar control pane, there's a place to shoot in some questions and we'll get to them, and we'll with delight ask them and to put them in front of George. And with that, thank you, George, for giving us some time today.
Hey, many thanks, Campbell, and thank you to everyone for joining us this afternoon. The title of my presentation is the Phoenix Gold Project Feasibility Study, which is obviously on track for the second half of this year. We do make some forward-looking statements within the presentation, so obviously I draw your attention to the cautionary language. This presentation is on our website and available for review at your own leisure. Let's first of all talk a little bit about the Rubicon advantage. Now, as a junior exploration company, I believe the management of Rubicon is unique because between myself, my CFO, and my director of projects, we bring over 100 years of mining experience to the table. That mining experience is principally developing mines, getting them permitted, technically de-risking them, bringing them through the construction phase, getting them into commercial production, which can be difficult, and then managing them profitably and generating returns for our shareholders. Typically in the junior explorations, advanced exploration space, your CEOs and senior executives in the company are very good exploration geologists, but they don't typically have that bandwidth to get projects into commercial production and make money. Last year, as you're aware, we put out a very robust PEA using very conservative assumptions. And if you start to look at this project at today's spot prices, then obviously the key performance indicators are off the chart. We're located in the prestigious Red Lake gold mining camp and have 28,000 hectares of land in that camp. We have significant infrastructure in place. And of course, we have vast tax loss pools, meaning that we won't pay any taxation on any profits that we generate over the life of mine. Let's talk a little bit about the pandemic and the COVID-19, and I hope everybody is well and safe on the call today. I'm thankful I'm able to say that the pandemic has not affected Rubicon's business. And the reason for that is on March 12th, we closed the corporate office. The executive team has been working remotely from home. There is no corporate travel. At site, we only have 30 employees on the payroll, and many of those work shift work. So on a regular day shift, for example, we would have no more than 8 or 9 people actually reporting to work. So it sort of lends itself naturally to social distancing, although we have implemented many other measures to ensure the health and safety of our employees. Over and above that, we had a couple of employees who, on the technical side, were traveling into Red Lake. From the middle of March, we asked them to stay at home, work from home. They were working on the feasibility study. We were obviously concerned that as they travel on airplanes and go through airports, they could bring the virus into the community and the camp, which was something we wanted to avoid. Now, on the feasibility study, that's obviously being conducted by an outside consultant, with the engineers and the principals all working from home. However, as part of further risk mitigation, we've asked the consultants to ensure in each discipline there's an alternate engineer or technical person available, so that if the leader, for example, in the environmental discipline got sick and was unable to work from home, there's somebody who can step in there at a moment's notice, who is well up the learning curve, familiar with the feasibility study and its progress, and therefore we don't lose any time. We are therefore on track to deliver the feasibility study in September of this year. And of course, you all know that in February we conducted a flow-through equity deal, and that put the company's treasury in a good position. And today we have approximately 14 million Canadian dollars cash in the bank. So let's talk a little bit about the share capital structure in the treasury. With that 14 million Canadian dollars at the current budget and spend rate, that would take us through till the second quarter of 2021. So we're well funded for all the programs that we currently envisage this year. As part of the restructuring of the company, we have a current liability. We strongly believe that when we issue the project feasibility in September, shortly thereafter, we are going to announce the project capital financing for this project. There will be a debt component, and of course that gives us an opportunity to restructure or refinance the Sprott lending facility there, which is showing at 12 million Canadian dollars with a 5% PIK. Currently we have 96 million shares issued. The options and warrants are now in the money. They have a weighted average price of $1.37, and as of now we are currently trading at $1.80, meaning the market cap of the company is approximately 175 million Canadian dollars. Now, I participated again on the last financing with another $100,000. So since restructuring the company 3.5 years ago, I now have $750,000 Canadian of my own money invested in the company at a weighted average price of $1.32. 8 analysts covering the company with a target range between $2 and $3.60 Canadian. And as you can see, we have a very strong institutional shareholder registry. Many of those institutions would have supported me when I was at Kirkland Lake. And when we restructured the company, they came in and seeded the new Rubicon. And they remain strong, supportive shareholders today. Now, the PEA that we put out in 2019, we used a gold price of $13.25 US at a 0.75 exchange rate, meaning 1762 Canadian. Now, we determined the gold price by doing a 2-year look back and a 1-year forward analysis of the top 30 analysts in the precious metal space who obviously cover gold. And we take the weighted average gold price. When we did this exercise now for the feasibility study, which we started in October of last year, the base case gold price will be run at $13.75 US, still well below the spot prices today. Now, on the right-hand side of that slide, you can see that there's 101 million Canadian dollars required in initial capital. Most of that relates to underground development and infrastructure. And I'll show you on a later slide where that development is going in. Here we're also showing purchasing $17 million worth of equipment right up front. The reality is we will probably look at a 4 to 5 year capital lease, and therefore we could spread those payments out over that time period, potentially reducing the capital requirement for the project funding. On surface, we want to put in a primary crusher next to the headframe, an office, a dry, a warehouse, a maintenance facility, and importantly, we want to raise the tailings dam by 2 meters, and that's the $23 million you see there, and 18% contingency gets us to 101 million. Now, in the PEA, we put in a very conservative 20-month ramp-up period to commercial production. And over that period of time, there's working capital required, which is approximately 46 million Canadian. The good news is that from month 8 and through to month 20, we actually produce about 44,500 ounces of gold. And at 1762 Canadian gold price, it generates about 75 million of revenue from gold sales, meaning we have positive cash flow from operations in the pre-production period of approximately 29 million Canadian dollars. Now, if we were to get into 2021 and we were selling our gold at 2,400 Canadian dollar gold price, which is the current spot, that would be an extra $700 to $800 an ounce margin over and above what we had in the PEA. Now, assuming all the capital costs and the feasibility study remain in line with the PEA, potentially that could reduce the funding requirement by almost 30 million Canadian dollars. But if we stick with the PEA, we would see initial pre-commercial production capital of around 72 million. By the time we do our inventory adjustments, that jumps up to 81 million. And then if we consider refinancing the Sprott loan, which at the end of the year would be worth 15 million, you can see the funding requirement for this project would be around 95 to 100 million Canadian dollars. Slide 7. If we look at the sensitivity table with respect to gold price and exchange rate, you can see at 1,700 and a 0.71 exchange rate, the IRR on this project after tax would be approximately 93%, and 371 million after tax NPV using a 5% discount rate. And there would be 500 million Canadian dollars in free cash flow generated. I'm going to show you in some future slides, though, how we believe the life of mine could potentially increase over and above the PEA, which is currently only showing at around 6.2 years. And that obviously is going to further improve the economics in the base case model. Now, a little bit about on the downside risk. At a conservative 135 million NPV for the project as a standalone, over and above that, Rubicon controls 28,000 hectares of land in Red Lake. And before I arrived at Rubicon, when obviously there was a strategic review being ran, including the sale of the company, its assets, there were 2 bids made for only the regional land package of 25 million and 20 million and 25 million Canadian. And that was in a distressed situation. Given that we're no longer in a distressed situation, given the robustness of the gold price and the macroeconomics that are happening and how that might affect gold going forward and gold equities, and given that Evolution Mining, a mid-tier Australian company, is coming into the camp, we believe the land package is worth a minimum of 30 million, if not significantly more. Over and above that, the 690 million of tax pools that we have, approximately half of those monies could be used outside of the Phoenix project. Now, when Newmont Goldcorp sold the Red Lake assets, Newmont as the parent company retained all the tax pools, because those tax pools could be deployed at Borden Lake or at Musselwhite, other operations they have in Canada. So that means Evolution coming into the camp as an Australian corporation with no business in Canada has no tax pool shelter. That therefore means that Rubicon's tax loss pools could be hugely strategic to an evolution or other strategic looking potentially within the greater Red Lake camp. But if we add those numbers up, we get 185 million. We deduct off the 15 million in Sprott debt, and at a base case valuation, we get about 170 million, which is the current market cap of the company today. If, however, we were to compare ourselves with some of our peer groups, even within the camp, I still think there's a lot of room for the share price to move up in the next 6 to 12 months, even despite the significant move up in the share price in the last 3 to 4 weeks. So slide 9, this is a photograph looking down on the camp. So we have a 1,250 metric ton per day permitted mill, and that permit is based on an average throughput over a month. But the mill was built and constructed for 1,800 tons per day. And in some areas, it was even built and designed for 2,400 tons a day. There's a 720 meter deep shaft with a full hoisting system, 10-ton skips that sit over the cage. And that hoist will hoist between 25 and 3,000 tons per day over a 24-hour period. We have a 44 kVA line right into the mine site. There's a permitted tailings pond. There's a 200-man camp. And of course, we're 8 kilometers outside of Barmatown in the prestigious Red Lake gold mining camp. And in the background of that slide on the right-hand side, you can see the Koshna headframe. And on the left-hand side background, you can see the milling and processing facilities for Evolution's Red Lake complex. So slide 10, let's look at the production profile that came out of the PEA. So over the 6.2 years, the average annual production was 80,000 ounces with 5.3 grams per ton diluted head grade reporting to the mill. C1 cash costs were $624 US and all-in sustaining cost $882. If you had to add in the pre-commercial production capital, the corporate overhead and G&A, and the 3% royalty, and look at the all-in cost, we'd be looking at somewhere just slightly below $1,100 US an ounce, which obviously is still well below the gold price we're using within the base case model and today's spot prices. Now, on this slide, I'll draw your attention to the 154 million of sustaining capital. We think there's an opportunity in the feasibility study where that number potentially could come down, and I'll explain that on the next slide. So on this slide, everything you're looking at in purple is a sunk development cost. So we have the 720 meter deep shaft, 14,000 meters of development already in the mine. The light blue that you're looking at is the pre-commercial production development, which is approximately 6,000 meters. And at $6,000 Canadian per meter, that would be 36 million Canadian dollars. Remember back to the 43 million I explained for the pre-commercial production capital of underground development and infrastructure. A significant portion, obviously, of that is represented in the blue there. Now, a couple of things to note with that. Because Rubicon 1.0 never declared commercial production, that means that this development qualifies as a Canadian development expense, or CDE, and is therefore potentially flow-through financeable. So when we get to our project financing and we're looking at the equity component, we might be able to fund a significant portion of that using flow-through dollars, which obviously generates a premium to the spot price. The other point I want to raise here is with these deposits, which are high-grade, nuggety style in nature, maybe not that contiguous, the secret to success of mining them is to put your capital development 12 months ahead of your mining crews. Although this deposit is now drilled off in the measured and indicated category at a 15-meter drill density, we still want to infill drill that, and it'll be important to get the capital development far enough ahead so we can bring in small air drills and drill it off on 7.5 to 10 meter centers. When we do that with these style of deposits, there's positive surprises, but there's invariably negative surprises. But if you have 7 or 8 mining horizons opened up and 60 to 70 stopes available, you've got the optionality and flexibility to still make your guidance, and you don't disappoint the market. And that was one of the failings of the old Rubicon, is that they really tried to run to commercial production when they hadn't put in a solid basis for mining. Now, the sustaining capital you're looking at is represented in the green. And you'll notice that the ramp goes all the way to 1,400 meters below surface. That's where the current inferred resource actually stops. But when we come to do the feasibility study, we are only allowed to use measured and indicated resources, converting over to proven and probable. So right now, we believe when we pull the final trigger on the next 43-101, the M&I will extend to about 1,100 meters below surface, meaning that's where the bottom of the ramp will go. If we save 300 vertical meters of ramping and 5 to 6 mining horizons and the raises and ore passes and vent passes that have to go in typically, that's going to save us between $30 and $50 million of sustaining capital when we compare it to the PEA. The other thing to note about the PEA is that we put in the development rate with multiple headings at 14.7 or 5 meters per day. That's quite conservative. So for example, if we were able to go at 20 meters a day, which is still easily achievable, that could shorten the timeline to commercial production from 20 months to perhaps 15 to 16 months, which would be a further $5 to $8 million saving on the 46 million we currently see in working capital within the PEA. Slide 12, all we're trying to show here is the significance of the tax pools that we have. When we compare ourselves with other single asset companies in Canada, typically we see that they would be paying about $144 an ounce of taxation. In the PEA, despite having positive, robust economics, after 6.2 years, we still had 521 million Canadian dollars of unused tax pools that could be used both at Phoenix and outside of the Phoenix project. So at a higher gold price and maybe a longer life of mine, we would expect more of those tax pools to be depleted. But certainly we still think that at the end of the initial life of mine, there will still be some tax pools remaining. Slide 13 shows you the growth in the resource model over the last 3 years since I've came on board with my team, and we've completed significant amount of infill orientated drilling. So as I alluded to earlier, in the measured category, the drill density is now 8 meters. In the indicated category, the drill density is 18 meters. The weighted average drill density now in M&I is 15 meters. So if we can put mining shapes into the next resource model, and we can generate reserves, which is mineralization that is economically viable based on a 15-meter drill density, I'm confident that we're going to be able to deliver on that plan, particularly if we plan to have the capital development 12 months ahead with a significant amount of further infill drilling. Of course, after the M&I, we still have 464,000 ounces of inferred. That takes us to 1400 level, but Rubicon 1.0 drilled this deposit down to 1600 meters below surface, and it was never cut off at depth. So down in that between 14 and 1600 level, there's still 250 to 350,000 ounces of non-compliant material, which is on about 100-meter drill density. It doesn't qualify for inferred resource because for drill density for inferred, it has to be between 40 and 80 meters. And of course, we did a bulk sample 2 years ago in the summer of 2018. We got 14% more gold out than what our resource model predicted, 7% higher on tons, 6% higher on grade, and we reconciled very well to the model, and that was verified by Goldrun Associates, who came in and did an independent engineer's report on that. Now, the PEA converted the M&I over into the mineable ounces at 70%. And I'm going to show you on this next slide where we've been drilling since October of last year. So that resource we just were speaking to was cut off in September of last year and was published in January of this year. But since October, we've been drilling in that rectangular box where there's approximately 190,000 ounces of inferred material. And you'll notice how the rectangular box only goes to 1,100 meters below surface. And that's why I referred to the sustaining capital and the ramp only going to that level. If we could convert 100,000 ounces of that 190 over into M&I, and that fed into the feasibility study, at a 70% conversion, 900,000 ounces of M&I would give us 630,000 ounces of reserves. And at 80,000 ounces potentially of annual production, we'd be looking at closer to an 8-year mine life. So all of that drilling in that box has been completed as of early May. We put out the last of the exploration results there last week. All the assays and composites and drill data has been given to the consultant, and that's going to be worked into the feasibility life of mine plan and should be in place by the end of this month. So 59% of the feasibility tasks have been completed. We've spent 54% of the money. And in the last several months, what we've started to do is now focus our attention on what we call close proximity targets. And I'll speak to that very shortly. So here is Rubicon's land package in Red Lake, 28,000 hectares. It's represented in the light blue, the cyan color. And you'll notice how it butts up against a lot of Evolution's property. They control approximately 31,000 hectares of land within the camp, and combined these land packages at over 60,000 hectares would represent about 80% of all the land in the camp. Slide 17, if we draw a 10-kilometer radius out from the Phoenix Gold Project, you notice how it encapsulates the Campbell, the Red Lake, and the Koshner mine. And if you had to draw a line through those three producing mines, it would take you through the McQuaig and DMC property, which Rubicon 1.0 drilled, and Slate Bay. Another interesting property for us would be East Bay. Again, Rubicon 1.0 drilled on that property at depth. They found mineralization with the same stratigraphy, lithology, mineralogy as what Evolution or Goldcorp had reported at the gas zone, which is right next door and has a compliant resource of 360,000 ounces, 8 grams per ton. Would seem to indicate to us that perhaps the gas zone extends over the imaginary boundary and onto Rubicon's East Bay property at depth. My goal with this company has always been to technically de-risk the Phoenix project and pull the project and the company up by its bootstraps. So now that our core asset is about to produce a feasibility study with reserves and robust economics, that's why I'm now starting to pay attention to the close proximity targets. As we start to be successful with those, you can expect Rubicon to start focusing its attention in 2021 on its regional land package, which is vast and needs to be explored in Red Lake. So here's a cross section over 4 kilometers from the Phoenix going out to the east and the west. And let's first of all start with McFinley. McFinley was a former producing mine very briefly in the early 2000s. Today it has a non-compliant resource of about 68,000 ounces at 6.8 grams per ton in the ground. It's not shown on this slide, but we have access to McFinley off the Phoenix shaft on the 44, 88 and 122 levels. We can step right off the station there, walk into the heading, which is about 500 to 600 meters away. So in the first quarter of this year, we've been taking chip and muck samples down there with grades ranging anywhere from 2 to better than 20 grams per ton. That's allowed us now to devise a drill program. And in the last couple of weeks, with drilling winding down at Phoenix, we started to drill on the McFinley deposit. And you're going to see those exploration results coming out in the next 2 to 3 weeks, and for that to continue for a couple of months. In the fourth quarter of this year, after we release the feasibility study on Phoenix, we want to come out with a compliant resource on McFinley. And the strategy here is really to show the market that over and above our core asset, we have significant incremental and organic growth, which we can take advantage of through the existing infrastructure that we have. Now, where McFinley gets very interesting, in my opinion, is that 2 years ago, we had a drill down on the 685 level, drilling the Phoenix deposit, which is on the right of that slide. We had idle time on the drill. We flipped it around 180 degrees, poked out a 550-meter deep hole, and hey presto, we went through 4 bands of mineralization. But more importantly, the same lithology, structurally, mineralogy style is what we see 550 meters higher up in the package. So now we have a vast untested area which sits 500 to 600 meters from a full production shaft with a big hungry mill on surface, which is not going to be fully utilized through the Phoenix deposit. Then back to slide 18, you can see the Penn, the Carn, the Island Zone. These blocks are 1 kilometer blocks. So from our 244 drift out to the Penn Zone is about 500 meters, or approximately 3 months of development to get out there. In April, we put a diamond drill on that exploration drift. We drilled 2 holes out to the Penn Zone. We don't have the assays back at the moment, but we've gone through basalt. Typically at Phoenix, when we go through basalt, that's where we find our quartz veins and our sulfide, which typically contain our gold. So we're definitely in the right rock package and expect to see those exploration results coming out in the next several weeks to next several months as well. And we want to put out a compliant resource on the Penn Zone in the first quarter of 2021. And here you can see some selected drill results from Rubicon 1.0. In the Google map there, the dark area would be obviously the lake. So drilling has taken place either from a barge or off of the ice. And you can see some really nice juicy intersections there on the left-hand side. This is the first time the Penn Zone will ever have been drilled from underground, where I think we're going to have better angles on the various veins of mineralization that are indeed there. So to summarize, I believe Rubicon represents a very unique investment opportunity. We're very different than other advanced exploration stories, given we have significant infrastructure already in place, meaning timelines and capital to commercial production are relatively small. We have a proven management team, in my opinion, with a very good, strong track record of delivering value for our shareholders. We're probably in one of the most safest mining jurisdictions from a socioeconomic and geopolitical perspective. And I'm seeing lots of great things happening in Red Lake. Our vast land package gives us huge opportunity for further exploration success. And let's not underestimate those tax loss pools, which I think are going to be very valuable to Rubicon and could be hugely strategic. And then it's not in the presentation, but one last point. You probably have seen that we've decided we wanted to rebrand the company. Our articles of association require us to go to our shareholders to do that. We're proposing Battle North Gold Corporation, and we want to rename the project the Bateman Project. We decided on Battle North because of our resilience, our strength, our fortitude, our determination in trying to keep this company moving in the right direction and essentially resurrecting it almost from the grave. So I think that that name is a good name. And the Bateman Project is well known and synonymous with the Red Lake camp, given it was one of the early explorers there within the camp. And we feel this is the right time now to rebrand the company. We've really taken it on the chin over the last 3.5 years. We have not shied away from the Rubicon name or what happened in the past. And we wanted people to know if they were taking meetings, they were taking meetings with Rubicon. And if they didn't want to take meetings, we were fine with that. But given how we've technically de-risked this project, and there's a feasibility study which Rubicon 1.0 never had, with reserves coming out and a very robust economic model, we feel now is really the time to move on and let go of the shackles of the past. So with that, I'm going to hand back over to Campbell to open up the lines and answer any questions that anybody may have.
Onto the question part. Again, please shoot in your questions through the control panel, and Amvest will ask them of you. And we've lost video on you, George. If you want to, we want you up here. Excellent. So just want to get this one out of the way. Rubicon 1.0, we'll just talk about it first, and then let's go to Rubicon 2.0. What is the elephant in the room? What happened? How did they get it so wrong? What do you see coming in? What do you say when you're asked this obvious question? And now that you've had 3.5 years to reflect on the subject,
well,
the company line.
Well, it's a great question. It's the obvious one, and really to fully answer it, I'd need about 2.5 days of your time. So please forgive me for trying to do a summary version in the next 2 minutes. But any project that tries to go to commercial production and bases all their engineering and designs on preliminary economic assessment with no reserves is high risk, no matter what anybody tells you, particularly in the Red Lake camp, where the camp is known for high-grade nuggety style deposits. So that was a big no-no. The other thing is the geological structural model was not understood because they never completed any orientated drilling. So all the drilling that we've did over the last 3.5 years has all been orientated drilling. And without getting too technical, what that means is when we remove the barrel from the core of the drill, we know in 3-dimensional space how that core is orientated. So if the listeners think about it like a clock face on the wall, we know where 12, 3, 6, and 9 o'clock is located. When that comes to surface and the geologist has 12 o'clock facing up, and he starts to measure the dip and the azimuth of these quartz veins which carry the gold, when he puts that into the computer, we can do several things. It's almost like joining one of those dot to dots. We can see if there's any patterns in developing and whether we have continuity in the deposit. And at the same time, we see, are there patterns there? And we found that these quartz veins do run in an east-west direction and carry super high grade. But the high tide basalt itself, which was the main mineral rock type that constrained the gold, it runs mine grid north-south. And the good news is within that model, there were veins running north-south and running northwest-southeast. And that's what allowed us to hit upon a Rydell shear system. Now, the high tide basalts is not one contiguous land rock package, which was really what was being modeled previously. The package is broken up because of boudinaging. There's a big East Bay deformation fault north of us, and over millennium it's pulled the rocks apart and it acts like a rubber band, and once it reaches its tensile breaking strength, these things snap, they break, and they form boudinage lenses, almost like pear shapes. It's in the appendices of the presentation. But the test trial mining that we did actually proved that if we stay within the basalts and these basalt packages are large enough to deploy a bulk mining method, we can actually get good recoveries and reconcile well with the model that we put in place. And the other thing was that the model they put in place was overly optimistic. It had high cutoff grades. The coefficient of variance, which is a sort of statistic that geologists will look at, was very high. We've now got that thing down to about 3 to 3.5, which isn't bad for this style of deposit. And the last point was, when I visited the site before I joined Rubicon, I did 4 months of my own due diligence. I went underground and I could see that the mining side of the operation was horrendous. The amount of dilution that was being taken looked to be fairly large. And of course, if you don't know where your deposit is, you don't know if you're in the hanging wall or footwall or where these veins are, you're going to take a lot of dilution. And when we did our bulk sample from 3 stoping blocks 2 years ago, we did a cavity monitoring survey of each stope because we needed to understand the void and how many tons. one of the stopes we mined was adjacent to an old stope that was previously mined. Our external unplanned dilution was about 8.9, let's call it 10%. The old stope, which I had the surveyors survey for a CMS, was sitting at 50% dilution. So that means if they were mining 6 grams per ton, the actual head grade reporting to the mill would have been 3 grams. And that's exactly what they found. So I'm sorry for what happened in the past, but this is where, when you get into the junior space and you're bringing mines into production, the management is so critical, because you can take a world-class deposit, and I'm not saying this deposit is world-class, but you can take a world-class deposit and you can destroy value. You can take an average mine and put in top quality management, and you can make significant return on investment for your shareholders.
Okay, now we're going to move on forward. 2.0.
Great.
Excellent. Stu?
Yeah, thanks, George, the presentation. Yeah, quite a few questions, I guess. So on the tax losses, back on the slide, you had the different categories in the table. To claim them, do you have to spend, do you have to allocate the dollars to each category, like underground development, exploration, etc., to claim them, or is it a blanket pool?
No, exactly. The pools are broken up into a Canadian exploration expense, a CDE, there's an Ontario mining tax, there's an ITC. I leave that for the accountants. But the good news is that about approximately 3 years ago, the CRA came into Rubicon and did a tax audit. And actually, they moved some of the pools from CDE up into the CEE category, which is 100% taxable. So those tax pools have been audited by CRA. And we've also had opinions from other accounting firms on the use of the tax pools, both at Phoenix and outside of Phoenix. So we're very confident that they're available to the company in the various categories that we've just spoken about.
Yeah, fair enough. And an incoming party, like a potential acquirer, are they still able to use them if they keep the cash spend within the Canadian subsidiary?
Yeah, exactly. We've spoken to a group known as Thorstensons, who are regarded as the preeminent tax expert within Canada. And depending on how you structure an M&A transaction, there's various ways in which it can be done. But yes, a good portion of those tax pools could be used in an M&A transaction. So for example, if you had Project A that was in Ontario and their post-tax NPV on their project was $100 million lower than their pre-tax NPV, if you could put those two companies together, potentially the post-tax NPV of Project A just increased by 100 million Canadian dollars.
Yeah, thanks for that. Thanks. Oh, actually, one more question on the tax losses. Do they expire? Do they have an expiration?
Yeah, they do. They typically have about a 20-year life, and right now our weighted average life remaining would probably be in and around 13 to 14 years. Remember when Rubicon 1.0 was building this facility, which is predominantly where all those tax pools came from, the biggest spend was in 2014 and 15, when the vast majority of the construction was going on site, such as the shaft sinking, the mill, the underground capital development.
Yeah, thanks for that. Gabe?
Yep. Hey, George. So just a kind of a question that some generalists may have, what do you say to mining under a lake? What effects does that have at all to a mining operation, if any?
Yeah, I mean, obviously mining under a lake carries with it some risk that you've got to be aware of and you've got to take into account. But fortunately, with the rock type that we have, it's not very permeable. So believe it or not, when you go down into the mine, it's a very dry mine. There's not a lot of water. But precautions that you have to take, we leave what's known as a crown pillar, and that gets calculated based on the rock type and how deep the lake is and what style of mining. But we leave a 50-meter crown pillar below the lake bottom to the upper levels that we will eventually be mining. and we're very confident that there's going to be no catastrophic failure there. Other things that you have to be careful of: Rubicon 1.0 drilled from the lake, as we saw earlier, those holes have to be cased with cement, and you need to know exactly where those holes are underground. And of course, if you're developing and we have all the drill holes on the plans, we need to be aware that we might be encountering drill holes. So we do what's known as cover drilling ahead of ourselves to make sure there's no unexpected water, because even if you had a 2 or 3 inch hole that was making water, that's a significant amount of water coming into the mine. But the good news is, again, we have a management team in place with vast experience of managing, producing mines and coming across these challenges in the past, and we know how to mitigate the risk, if not even terminate the risk.
Yep, thank you. And what synergies would a neighbor or a newcomer into the camp have if they combined with Rubicon? What would be the sales pitch on that?
Well, look, I think if we start, in the macro picture, I think consolidating the entire land package would mean that the entire data set of regional exploration would be able to put together, and with that, you're probably going to be able to highlight some primary key targets from a regional perspective that needed to be followed up on. So, for example, in the presentation I gave the example of the gas zone in East Bay. We definitely think there's a big opportunity there. If you follow the trends through the Campbell, the Red Lake, and the Kouchner mine, it goes through the DMC and Slate Bay. We would expect, Evolution probably has information which would show that following up on drill results on those properties probably makes a hell of a lot of sense. So I think that would be one big synergy. I think another one obviously would be the infrastructure within the camp. Right now, there's probably too much milling capacity there for the production, and there's probably an opportunity to optimize the milling capacity. We don't know what other groups are going to do within the camp as far as rationalization. Obviously, Evolution has just taken on the Red Lake assets, and they're digesting those assets, but we don't know what's going to happen with any rationalization. And of course, with other juniors in the camp ramping up production, and then ourselves next year requiring additional labor, there's an opportunity to share in the labor pool, which obviously is important for the Red Lake and the greater community.
Yeah, thank you. Campbell?
Yeah. What percentage of your extensive land position has been explored, and within that, what potential for other mineralized zones do you currently see in the large land package away from the current areas of interest?
Yeah, I haven't spent a lot of time really delving into the regional land package. As I said in the presentation, my goal here really first and foremost has been to de-risk Phoenix. I really feel that we're at that stage now where we can prove that to the market, and I'm trying to build this company up, pull it up by its bootstraps. So it's only, as I've said, in the last few months we've been paying attention to these close proximity targets. Of the entire land package, my gut feeling would say that we've probably explored no more than maybe 10 to 15%. There's already been some significant mineralization hits. Several years ago, what happened was Goldcorp at the time released a vice president of exploration from Red Lake. They were rationalizing some of their labor force. And we picked up the gentleman, and he had 22 years of experience working only in the Red Lake camp. We picked him up for 6 months, and he came into Rubicon, and he went through our entire regional land package, and he prioritized through a ranking system all of our claims. So today in our data room, we have a 267-page report that ranks all our claims. It even gives us a very high-level work program and high-level associated costs. Now, the individual did not tell us any confidential information which Goldcorp had on the other side of the property boundary, nor did we ask. But obviously, if he's putting together the report, he's working from a knowledge base of having some intellectual knowledge and property. And we strongly believe that that report is going to guide us well when it comes to the regional exploration, which, as I said, if we execute on our plan over the next 6 to 9 months, we would be executing on that at some juncture in 2021.
Thank you. Pulling us back to the mine plan, what would the IRR be if Canadian dollar was at par with the US dollar? Have you thought of that?
No, I haven't. But I mean, obviously, it would. I would have to say that it would go down because all the numbers that we're showing are in Canadian dollars. But with that, I mean, just to give the listeners some strategy here. Look, in business, timing is everything, and sometimes you need a little bit of good fortune. I would say at the end of this year, with the feasibility and reserves in place and a robust financial and economic model, if we're looking to finance this project, I'm not a big believer in hedging, but given that we would have a single asset company that we are bringing into production, and given the history of this deposit, I think hedging a portion of our production and maybe even doing something with the foreign exchange rate would probably make a ton of sense, at least over that pre-production period. So it mitigates some of the risk if there was a move the other way, let's say in the exchange rate or the Canadian dollar gold price. Personally, I think the chances of that happening are minimal, but as a prudent management team, I think that would be something we would consider the end of this year, about hedging the gold price and the exchange rate if we were still at these levels, bringing this deposit into production.
I love listening to engineers and their prudence. So it's music to my ears.
And on the hedging, do you have a view of how much you'd want to be hedging in your production when you get to that point, or keeping it most unhedged?
No, it's too early to say on that until we have a full financial and economic model and we can see, what's the reserve tail on this, how much debt could the project take on, by taking out, first of all, the Sprott lending facility and then perhaps increasing the debt slightly. We've got to be very careful that we don't take on too much debt. So until we see that model, we won't know, exactly what we want to do. I can tell your listeners, however, and many of them are probably very well educated in the mining space, if we do any of the financing using a commercial bank or a lender of that ilk, there probably will be a covenant in the loan agreement that we hedge a portion of our production over a period of time. It's a fairly standard clause that goes in. And as I said, in this situation, I don't think that's a bad thing.
Yeah, and on the reserve tail, both some, as you touched on, debt funds and some equity guys like to see, kind of that 10-year mine life kind of number. Are you kind of confident in your exploration target and exploration program to be extending that mine life to hit that reserve tail and also that kind of 10-year sweet spot?
Well, you raise a great point. The 10 years is definitely a benchmark, but think about that. That 10 years is normally a benchmark when you're a greenfield project and you're bringing a mine into commercial production. The beauty of Rubicon is that the mine is essentially built. There's $700 million of sunk cost. It's only an incremental 100 million, maybe, to put this thing into commercial production. So the reserve tail doesn't have to be as large, or the life of mine doesn't have to be as large as your typical standard project because of what went on in the past here. But in saying that, remember the slide we spoke about, the M&I. If we can generate a life of mine of 8 years at 80,000 ounces of annual payable production, that M&I only goes down to 1,100. Between there and 1,600 meters below surface, which includes some non-compliant explore ounces, we've got anywhere between 400 and 600,000 ounces that, as we drive the ramp down on ourselves, we're going to be infill drilling, moving inferred into M&I and then reserves, and we're going to be exploring. If you ask me today, and I've got no scientific proof that I could put out and say categorically, but If you ask me today, you know, as an engineer and having 30 years of mining experience behind me, what I think the real life of mine is today with no further exploration success, I think 10 years is definitely on the cards at 80 to 100,000 ounces of annual production.
Yeah, it's a good point. I never thought of it that way with the brownfields kind of approach. You know, all mine builds and restarts have their hiccups. You know, in your experience, having built a few mines, what do you see as some advantages and maybe some challenges to overcome in, you know, with Rubicon 2.0?
Well, the good news is that the mill performs extremely well. Rubicon 1.0 put 60,000 tons through the mill. We put 40,000 tons through. They got a 91.5% metallurgical recovery on low grade. We got a 95% metallurgical recovery on higher grade, and 43% of our gold came off with from gravity. So we definitely categorically know that when we go into production, that mill is going to hum along extremely nice. They had formerly issues with ammonia in the pond, and again, coming back to the first question that got raised, they started to run the mill in the tailings pond by not putting the ammonia reactor into the wastewater treatment plant. So they were running towards commercial production, and it was in the design. It's a $5 to $6 million capital cost. So you generate ammonia from the ammonium nitrate explosives in the mine, but a substantial portion of your ammonia comes from the cyanide destruction circuit. And you cannot discharge from a tailings pond in Ontario if your ammonia is 10 parts per million or above. And they eventually got up to levels of 100 parts per million, and they had to shut down the pond. If you shut down the pond, you can't run your mill, and there's no point running the underground, incurring costs when you're not offsetting it with revenue. So it was a vicious circle. So again, we're taking our time. We're putting in the capital cost. There's a $5 to $6 million for an ammonia reactor. That'll go in, and that problem is going to be resolved. I think our biggest issues are going to be underground, with ensuring we can put that development in on time, on budget, bringing in these air drills and doing this infill drilling. And when you do that, as I said in the presentation, you're going to have positive surprises, and you invariably will have negative surprises. But provided you're far enough ahead, you can flex on your production plan for the next 3, 6, 12 months and still make your guidance. And that's how we're going to mitigate that risk. If we really wanted to, next year, I could be mining in this deposit within 3 months and be sending ore to the mill, stockpiling it, and generating revenue. But in this style of deposit, that's not the approach, because we'll fall on our face on that one. We have to take our time, and we've got to build that into the model and recognize that's the reality of mining in these deposits.
Just a couple quick ones on resource. What's the deepest you've drilled, and what'd you find? And in that sort of long, your regional exploration program, where are you seeing, results that are encouraging you to follow up on? And what are those results?
Yep. So the deepest hole that we've drilled since we restructured the company has been approximately 1,400 meters below surface. And down on those levels, we're finding, typical grades on average that are between 6 and 8 grams. We find a few holes which are dusters, and we find other holes which are 20 grams plus. That's fairly typical for this deposit, but it would appear that the sort of 6 to 8 grams per ton does consistently seem to exist at that depth. Rubicon 1.0 drilled in 2013 and 14 as deep as 1,600 meters below surface. And again, similarly, they had some really high grade intersections, and they had some holes which were low grade. So I've got to think that the sort of range I just described exists down to 1,600. Interestingly, the deposit's never been cut off at depth, and next door at the Red Lake mine, they discovered their high-grade zone below 2,000 meters below surface. And for me, at the right time, when we're not there yet, but at the right time, I'd love to drill this deposit at depth. The Red Lake camp is known for having super high grade at depth, And although we're talking 1600 meters below surface, that is not particularly deep in the Red Lake camp. So at some stage, given all the infrastructure, that we would have, I'd like to drill a few deep holes below 2000 meters and see ultimately what's there. I think, as I referred to earlier in the regional land package, the McQuaig and the DMC property is high priority for me, only on the basis that there's been historical drilling conducted there. There are some of the results on one of the slides, and some of the intersections they had were multi-ounce over several meters, and it is on what's known as the mine trend through the Cochenour, Campbell and Red Lake mills. So I think within the camp, that would be a definite area of focus for me when we get there in 2021.
Yeah, I mean, we've been saying with some of the, in the Red Lake endowment, these orogenic kind of gold structures, those higher grade structures at depth. So it's good to hear that, that's long-term plan for you guys in terms of exploration.
Right.
Yeah.
I think we've exactly reached the top of our hour, and want to thank everyone for tuning in today. And in about 2 hours, the link will work for the replay. Please feel free to share that far and wide. And after you log off, there will be a queue to fill in your comments and feedback. Feedback's really important. Love to know your thoughts and constructive criticisms, and they will make their way back to George. So this is a great way to tell him what you think. And we'll meet again soon. Thank you, and good day, everyone.
Thank you, everyone. Appreciate your time today. Thank you ever so much.
Thank you.
Thanks.